In this video, we're going to be reviewing how a dividend growth portfolio may be a useful tool to help you protect your retirement, to ensure your retirement. We're going to do this through looking at 3 different portfolios side by side, how they performed over a 10-year time horizon, and then again, how they performed over a 2-year time horizon, specifically the 2022 market correction. Now, I'm a big believer in using this dividend portfolio as a tool in the right circumstances. If you haven't watched my prior videos on asset allocation, one of the psychological problems that comes up when we use asset allocation as the main guide for our portfolio is that we end up with what I call the snowball of negative confidence, which is when we make impulsive decisions when markets correct, and then we get hesitant because we made a mistake, and then we continue to reinforce this negative snowball of not believing in ourselves, not trusting the conventional wisdom. Now, I think the dividend growth portfolio, or different types of dividend growth portfolios, can be a really useful tool in helping mitigate that. We're going to go into this in the video today as well. The first thing I'd like to show you is let's set up the groundwork for these 3 portfolios. I'm going to show you 3 asset allocations on the screen. We're going to talk through the 3 of them and then put them through the lens of this income portfolio. The first asset allocation you see here is a 100% stock allocation. This is a portfolio model using Portfolio Visualizer that's 100% invested in VTI, which is the Vanguard S&P 500 Index Fund. We're going to compare this portfolio against this portfolio, which is a 65% stock, 35% bond, 5-fund Vanguard portfolio. And then we're going to compare that finally to a income portfolio or a dividend portfolio that is 96% stocks, 4% bonds. It's really important when considering which type of portfolio is right for you, and in this case, whether a dividend portfolio is right for you, to understand what the desired outcomes are out of choosing that type of portfolio. Now, the main benefits that I see out of a dividend portfolio are the following. 1, it provides a stable stream of income that you can use for retirement spending without having to prune or trim at the underlying investments. Now, in a normal portfolio like a 65-35 stock to bond or 100% VTI, whatever example we're using here, in order to get access to the funds underlying, you have to actually sell the positions to get access to the money. In a dividend portfolio, you can buffer some of that because you have this stream of income being kicked off. Now, the second thing is, properly constructed, a dividend portfolio can actually provide a tremendous amount of diversification. I'm going to show that a little bit here when we go through the Portfolio Visualizer reports that I have to compare these 3 different portfolios. The third and final item that I like is that it can help reduce volatility and therefore reduce impulsive decision-making, because the main problem investors will have is that when markets are performing well, they don't pay that much attention to making changes to that portfolio. But when markets don't do well, or there's a sudden shocking event, we tend to make panic decisions. If we have a dividend portfolio that we understand, and we understand the metrics of how it performed and what purpose it's designed to serve for us, we're much less likely to make these impulsive decisions that lead to the negative confidence snowball. All right, so let's review a few of these portfolios side by side. Now, there are 4 key metrics that we use at Peak Financial Planning to help us understand the volatility and risk levels of a portfolio, and therefore make a good recommendation to a client based on their temperament and their needs. We're going to go into those for each of these portfolios, but first let's set the groundwork for each of these. The first thing that we're going to talk about is the time frame. So we ran these portfolio tests. One test is from 2016 to 2024, and the second test is from 2022 to 2024. I wanted to show the performance summaries of each of these portfolios, one over a longer time frame and one over a shorter time frame, so you can understand this. We're going to start with the longer time frame here. There are a few key metrics that we want to pay attention to when we're comparing these different portfolios. Obviously, the first thing that jumps to mind here is going to be the compound annual growth rate, which is this CAGR column. That is the rate of return that this portfolio has produced, or these 3 portfolios have produced from 2016 to 2024. All 3 of these portfolios have the same initial $1 million starting balance. And you can see here that the income portfolio, which is the top portfolio, has a 7.7% roughly growth rate. The middle portfolio is in the 7.2s. And the third one, which is the 100% stock VTI, 1-fund portfolio, has a 13% growth rate over this 8-year period. Now, growth rate isn't the most important thing here. That's part of the case we'd like to make. It really depends on what outcome you're after. What I'd make the case here is that we want to look at a few other metrics. One is shown on the screen, and then there's a couple that I'm going to show on a separate screen here. One metric we really like is this metric here of worst year. Worst year tells you what is the worst 1-year annualized performance of this portfolio. If you were to have held the portfolio for 12 months over this 8-year testing time period, what would the worst year return have been over that time period? And you can see here that the income portfolio, despite being 96% stocks, actually had a significantly better or much less damaging worst year than even the 65-35 portfolio. And certainly you would expect it to have a lower worst year than a fully 100% S&P 500 index fund portfolio. But you can see that highlighted here, that this income portfolio has some kind of inherent protection inside of it. Now, there's two other metrics that we like to use to track this. The second metric that we like to use is beta. Beta right here, you can see that the income portfolio has a 0.82 beta compared to the 65-35 portfolio, which has a 0.67 beta, compared to the 100% stock VTI portfolio, which has a 0.99 beta. Beta refers to the proportional amount that your portfolio will move in line with the market. It doesn't say that they'll always go in the same direction at the same time. What it says is if the market or the S&P 500 moves 1%, your portfolio will move that amount based on your beta. So a 0.99 beta on VTI means that that portfolio will move exactly the same proportional amount as the S&P 500. A 0.82 beta in a 96% stock portfolio is actually pretty good. It means that you're getting a lot of juice for the squeeze, but you're not always moving in perfect tandem with the market. Now, this is substantiated by a second metric here that we really like to look at, which is stock market correlation, which is the second metric here. And you can see that actually of these three portfolios, even compared to the 65-35 portfolio, the income portfolio, the dividend portfolio actually has the lowest stock market correlation, which actually means it has the highest rate of diversification compared to the market. Stock market correlation tells us how frequently will this portfolio travel in the same direction as the overall stock market. And it would make sense that again here you'd see the 100% stock portfolio 3 here, the VTI portfolio would travel 100% of the time in line with the stock market because they're actually the same thing. So we actually get better diversification out of a dividend portfolio that's invested in a set of stocks because it's got more diversification than an S&P 500 index fund. Now, when you combine those two things, that's very favorable. We have better correlation or a lower correlation while still getting a reasonable beta, meaning we're still getting a lot of juice for the squeeze, whichever direction the market goes. When we combine these metrics with our annual rate of return and our worst year, we start to like the dividend portfolio a lot more because it reduces portfolio volatility. So we're going to substantiate this idea that the dividend portfolio actually has less correlation and some kind of better defensive attributes by showing some rates of return here. The first rate of return I want to show here is the 2022 rate of return. You can see here that in 2022, the income portfolio had a less than negative 1% year, while the two comparable portfolios it's going against had significant drawdowns or significant negative returns. 16% in the case of the 65-35 portfolio and almost 20% in the case of the full S&P 500 index fund portfolio. Now, this is the key year where the dividend portfolio matters because this is the year where people panic and make bad decisions about their asset allocation or their investment portfolio and then create problems going into the future, where maybe they've rebalanced because there's a bad year, they rebalance to too much cash or into a money market fund, and then they try to time their reentry into the market and they end up in trouble. And then you can see here the second year, the 2023 recovery, yes, the income portfolio has a much lower annual rate of return of 4.83%. But at the end of this, when I show you the performance summary for just that 2 period, the income portfolio, this dividend portfolio, actually has the best rate of return out of these 3 comparable portfolios. And that's really the psychological element here, which is with this dividend portfolio, you get a stream of income that you can see, you can touch, you can taste. You don't need to trim at the underlying investments, which also means when you have a negative year like this and you're anxious to sell your investments to provide yourself income in retirement, with the dividend portfolio, you don't have to face that consideration. You still get your dividend payments in that year. And then in the second year, when it recovers, yes, you have a lower recover on a 1-year annual basis, but over that 2-year period, your portfolio actually outperformed, meaning you didn't have to take this long journey just to get your portfolio back to break even, which will be the case and is the case for the 65-35 portfolio and the 100% VTI portfolio. Now I'm going to show you this in the actual performance summaries right here. So if you see here right on the screen, this is a performance summary from 2022 to 2024, so the 2-year period. You can see here that the dividend portfolio, this first portfolio, has an almost 4% rate of return over that 2-year period, while the 65-35 portfolio still hasn't recovered despite the huge bar chart of rate of return in 2023, and the 100% stock portfolio has a 1.7% rate of return over that 2-year period. So you can see the dividend portfolio ensures and protects both from an income standpoint and a psychological standpoint, those market downturns. So in conclusion, we really like the dividend portfolio for certain types of clients because it provides that psychological buffer that helps us limit bad decision-making or impulsive decision-making. It's also easy to understand. It's also easy to understand how your income is produced from that portfolio because you're getting paid to hold the positions rather than having to sell positions and make decisions about what do I sell, why do I sell it now, how much do I sell of each position. The dividend portfolio will limit your upside over periods of time. You'll have a lower total rate of return over long periods of time, but not all that substantially lower. And so we'll wrap the video by showing this, the portfolio comparison between 2016 and 2024 here. And you can see that the income portfolio, which again is 96% stock, but has lower market correlation and a much lower worst year, has an almost 7.6% rate of return. It actually outperforms the 65-35 portfolio in terms of rate of return with much less risk to the downside. And that was proven and borne out over the course of these tests. It does give up upside compared to 100% into the S&P 500. Now you are basically comparing almost from an asset allocation standpoint, an apples to apples portfolio. You're comparing a nearly 100% dividend stock portfolio to a 100% S&P 500 portfolio. And yes, on an annual rate of return, the S&P 500 portfolio will outperform. It's just you have to be able to sit through at those really anxious times where the market has much wider volatile swings, which again is why we like the dividend portfolio for retirees or even very near retirement investors, because it can smooth out those anxious feelings and be much easier to understand. I hope this was a helpful exploration of the dividend portfolio and what applications it might have, and it might be helpful to see some of these numbers on the screen. If you have any comments or questions, please leave them in the comments section below this video. If you'd like to see other topics or subjects like this, you can also leave those requests underneath the video. You can also visit our website at www.thepeakfp.com for a bunch of helpful guides, including sample financial plans, 3-bucket retirement strategy guide, and a whole bunch of other things. You can also, if you'd like, schedule a free consultation with our financial planning team. We are fee-only and fiduciary financial planners using the free scheduling button on the website. And with that, thank you for your time and attention, and see you in the next video.